tech, and they're not quite over what yet, it seems.
Yeah, and it's also very dispersed and very distinct, sort of a repricing of expectations. So hyperscalers, if you think of them as the center of the ecosystem, are down on the week. All of their suppliers, basically semiconductors and power and storage and so forth, are up. And then the downstream clients of the hyperscalers, the software companies, the application software, are down. So really, it's interesting that the market has started to question the long-term returns for the hyperscalers, basically selling compute and the investment of new capital. But it's not being reflected in the hardware suppliers into those businesses. They're counting the money as spent.
Well, if we could go to the Wi-Fi Interactive for a second, I want to make a point here. In January, we saw a huge surge in consumer staples, and here we have the year-to-date performance for the large cap sectors. Number one is energy, and then staples. I was just talking about that. That's up 13.2%. That's number three. Materials is a gold and silver story, arguably, and copper too. Then we got industrials. That's cyclical. But then we got real estate, healthcare, utilities, and then you're going to see down here those mega cap sectors. They're all in the red. So what do you make of this rotation out of those AI leaders and into some of the more defensive names, if not in the company of some of these more cyclical names as well?
So you can certainly think that what we're seeing is a change of leadership from AI technology into, I would say, real economy names, like you mentioned, the cyclicals, materials, oil, industrials. And that's been going on since about before Thanksgiving. And I think it suggests that people are de-risking their portfolios a little bit. They're taking out the highest beta names, and they are migrating into what they view as participants in overall economic growth, with less bet on a technology marvel or revolution.
What do you think this says about the rest of 2026 then?
I think
Loaded question.
I think it's going to be very volatile because we have geopolitics at an extreme, an upcoming midterm. You've got a lot of uncertainty over the job market. We had a couple of pieces of data this week which suggested that the job market is slower than we thought, and therefore that makes it hard for the Fed to focus on inflation at all. We have a new Fed chair. So I would say the overarching theme for this year is going to be volatility, which puts a premium on being very comfortable with the names that you have and understanding that they're going to be down. For example, software holders figured out that their names are not invincible over the past month and a half, and they can lose money even in great companies. The only real impairment of value is when you sell due to something that is transient and give up real long-term value.
I want to go big picture now because I was reading your notes earlier and you've hit on something that I have to agree with. There's a lot of crowded thinking in the investment community, from portfolio managers to analysts, et cetera. Where do you think this goes from here? Because it didn't necessarily used to be this way. You had more contrarians, it seems to me, in the past.
Yeah, and the problem is that anybody who had a contrarian outlook or bias in their investing has tended to fade the things that have worked since 2013. And so to a large extent, the contrarians are out of business. They lost their capital, and the market voted with their feet in favor of people who are following trends and extrapolating, because extrapolation has worked. Companies have really increased the length, the duration, and the magnitude of their moat over the past 10 years. I think that all things come to an end, and I think when the constituency of the buyer base sort of coalesces around a received narrative, a kind of received wisdom, and become very comfortable, like we saw in software over the past, since the start of the year, they do so, at their own hazard.
And here's another kind of big picture question that I think is relevant right now. Since the pandemic, I mean, you think about that March 20th pandemic sell-off and then rebound to all-time highs in a very short period of time. We saw that even quicker in last April. And it just seems like the investing public is now kind of conditioned to believe that these wipeouts, that they're just going to be short-lived. And what do you think that means? How does that play out when we have a longer downturn?
It's going to make so first of all, it makes the market more stable because people are convinced that there is a Trump put or a Fed put, Warsh put on the market, so that whenever when markets are dislocated, even temporarily, somebody from the administration comes out and makes a soothing remark, or the Fed indicates that they'll quit their QT and start QE again. But as you suggested, ultimately, reality will hit, and it makes the dawning of that reality much more painful.
I hear you there. It's been great chatting with you. Thanks for spending some time with us, Brad.
Thanks, Jerry.
Today I'm honored to be here basically on Dow 50,000 Day. I mean,
break out your hats.
That is, I should have brought confetti. That's a big milestone. And what's wild is 2 days ago the mood was pretty bleak.
We're looking at Dow 40,000, right? Or zero.
The sentiment shifted, and as it does, it's shifted on just so quickly. And I was actually on a podcast talking about volatility was elevated, right? We saw the VIX over 22, almost 23, the highest levels we'd seen in November. And VIX is a measure of forward volatility expectations.
Yes, 30 days.
And I was mentioning, you have to remember, like people call it the fear gauge, right? Oh, the market's getting nervous. but volatility is a two-way street, right?
Yes.
That just means that the market is expecting to see moves closer to 1.5% to 2%.
Could be upside volatility too.
Exactly, and really that's today that is absolutely what we got. That surprised a lot of people.
I've been asking a number of guests this recently, and what kind of ties into the current situation. We've seen such quick moves off of the lows, starting with the pandemic, really. I think that's when it started in 2020. We had a 2022 bear market, so that lasted a bit longer. But then in April of 2025, we saw this huge rebound, and it put the pandemic rebound to shame. Is like everything just speeding up? And what does that do to investor psychology? Is this just setting us up for a lot of pain when we have a long, protracted bear market?
Well, I mean, 2022 was a bear market,
Yes.
and we all survived it. But I would say that buy the dip really has become a reflex for a very, very large part of the trading population. And people that have been trading for 5, 6, 7 years, this is kind of all they know. In 2022, even though it was a bear market, the market did slide about 20%. It was kind of a very gradual slide. It wasn't.
Yes.
We did not have like a crash, dislocation, scary kind of moment. It was very calm. In fact, the SIBO data shows that people that were short puts in 2022 actually still did okay. They actually still made money.
That's interesting.
because it just happened very smoothly. So this is another example of buy the dip, and I think it's a little different now this time around. And we were talking about this a moment ago. The dynamics with the silver and gold and Bitcoin,
Sure.
it all plays into it. And then we had all the Mag 10 earnings hitting basically over the last 7 or 8 days. And so the market was digesting a lot of information. And I think in the end, hindsight is 2020. It did look like some sort of an oversold situation because man, when we started to lift, you could feel the people piling in. The FOMO.
It reminded me of April 9th. Last year, and that was when the Nasdaq was up 10%. So it wasn't as big as that, but it was kind of a big day, and so I'll give it that.
Yeah.
What about, and just kind of keeping in the same theme of these markets speeding up, zero-dated options? What are some of the trends you're seeing there? Is there still the huge attraction? Is there more? Is that still trending up?
It's a great question. So zero DTE options, which are really just regular options listed about a month out, but they really see most of their trading activity on the final day. We have them in SPX, which is the S&P 500 index. They exist in a number of ETFs. Now they actually, although there's not daily expirations,
We got Monday and Wednesday now, right?
Monday, Wednesday in some of the super highly liquid NVIDIA, Apple, Google, IBIT. And so, and it's really only been a couple weeks for those contracts. And we've seen a pretty big uptake there. In fact, over 3 million contracts, I think, traded on Monday in those dailies, really on those 5 or 6 names. It was mostly NVIDIA and Apple and Tesla. So zero DT trading, it surprised people because of how popular it was, but it seems to have really, it's serving a purpose. And we're seeing about a third of the market is in zero-day contracts now. And in SPX, it's about 60% of the volume consistently is in the zero-day contracts.
I want to talk about the products that you at the CBOE might be considering adding to the mix, and based on some of the trends that we've been talking about. Prediction markets, they're huge right now. We were just talking to the CEO of DraftKings, and I know you're dipping your toes into that market, and for regulatory and compliance reasons, you can't really talk that much about it. You're pursuing something with the SEC as your regulator as opposed to CFTC, but just broadly speaking, where are you going in terms of new products?
So there were comments this morning when we had earnings, and JJ Kinahan recently joined CBOE, and he's a veteran in the retail space and in the options industry, and he is really kind of driving the effort in these prediction markets. CBOE specializes in financial instruments, financial contracts, so that really is kind of where we're focusing our efforts. But we are witnessing, really over the last year or two, this really interesting coalescence of risk taking, right? So you have, options and stocks and futures have been around for a long time, but then you have, prediction markets, and it's kind of all coming together. So it's really interesting to see. We will kind of specialize in what we're good at, but really, just watching this market, and the thing with prediction markets, they're a little bit easier than options, right? You don't have to pick an expiration and a strike.
One or the other.
Generally, it's kind of like yes or no, and I've traded them to kind of get familiar with them. They're very easy. Options,
and intuitive too. Options, you got to know some math.
You have, and actually, we believe, and I've talked to some leaders of some firms, event contracts can be a nice kind of introduction to risk and, really paying attention to the market. And so, somebody can go from, okay, I bet yes that the Dow would cross 50,000 today,